First of all, thank you very much to Iqbal Azaria for inviting us to participate in this panel. The subject matter is Brexit, the London market, and Takaful. So I'm going to introduce each of my panelists and then ask them to say a few words about the various aspects of the London market. Briefly, we have Mr. Dave Matcham, who is the CEO of the International Underwriters Association. This represents all the major insurance companies in the London market. We then have Mr. Terry Masters, who is the CEO of Aon Benfield Resolutions. Terry has been working in the London market for many years. And finally, we have Cameron Murray from Lloyd's, who is responsible for the Middle East and Africa. So I'm going to ask Terry to say a few words first about himself. Then I'll ask Cameron, and finally I'll ask Dave Matcham to say not only a few words about himself, but also developments more broadly in the London market. So yes, I don't know if those will work.
Is that working?
Does it work? No. Okay.
I didn't realise we'd agreed that first, James, but there we go. Oh, thank you for that. Thank you very much for the invitation, and good morning, everybody. Very pleased to be here. I'm looking at this with almost two hats on. As James pointed out, I've been at Aon a very long time and have managed I must confess, fantastic unit, which has a global reach and does a lot of innovations in Aon, help start new Lloyd's entities. We do a lot of the capital raising for different underwriting businesses around the world. We have just been working, and you saw it in Australia, on some of the very unfortunate child molestation that's come through various areas. We run the New Zealand Earthquake Fund, and so a whole range of different business units. I almost wear two hats at this. Clearly, I have my Aon hat on, but just as importantly, a London hat on. I know that Dave is going to speak quite a lot about the London business and how it has changed. And Aon is a global business, but some of us are always working very hard at bringing new business to London. And believe me, even with the 80,000 colleagues I have, that's often quite difficult because they clearly want to place business in their local markets as well. And I'm sure when Iqbal persuaded us all to come and speak this morning, one of the things I think he hoped we would get across was things that are happening outside of the Takaful industry, insurance industry, so that participants can see what else is going on around the world, because the rest of the insurance world does not stand still either, and everything that we do on Takaful insurance is within that total global environment.
Thank you very much, Terry. Can I literally pass it on to Cameron to say a few words about Lloyd's and how he sees developments?
Thank you, James, and good morning, everyone. It's nice to see you all and some familiar faces in the audience too. Yes, Terry, you've handed the baton on in terms of describing the environment we're working in. It's challenging indeed, and we've heard in our welcoming address as well just how challenging it is for the Takaful and re-Takaful industry. It really is determining Lloyd's priorities at the moment, that environment. We are focused very much on managing and how to manage the very tough and soft market that we are currently experiencing, with low interest rates, an excess of capital flooding into the market, very low natural catastrophe events. All of that creates a perfect storm, if that's not a contradiction in terms of the rating environment. So rates are down. It's very difficult. The margins are very, very slim. And so, as ever, more so than ever, probably, our focus is on focusing on underwriting discipline. Our combined ratio in 2016 was 98%. That was up nearly 10% from the previous year. So that's just an indication of how challenging market conditions really are. Whether you're writing conventional or whether you're writing Sharia-compliant insurance, those are issues that have to be managed. Despite the fact that the UK is withdrawing, or seems to be set on a course which will see it withdrawing from the EU, we still have to comply with Solvency II, and that's a big and very, very complex piece of work. Although we will be withdrawing from the EU, we are committed to continuing to implement Solvency II. Very large, very expensive, and very complex. We're too far down the road to be pulling away from that commitment. So that's something that we, as a market, will be continuing to focus on. Perhaps I'll come on to this shortly, but market modernisation, again, is something we are very, very committed to. Lloyd's is traditionally a very face-to-face market. It will continue to be. I think the nature of the risks that are brought to Lloyd's are very large and very complex, often necessitate that face-to-face contact between the broker and the underwriter in particular. But we've also been historically very paper-driven and quite inefficient in some of the ways that we have worked, and we are looking to address that in the environment we're in, where margins are so slim. We don't want to be adding layers of cost and complexity onto how we transact business, and so that's one of the things that we are really driving hard, taking out those layers of complexity, being much more intelligent about how we use our data, how we source our data, and how we use that data. A greater emphasis on electronic trading. All of these things will make Lloyd's a much easier place to do business with, and that will have a positive impact on our ability to provide non-conventional insurance products as well. And then, of course, finally, the Brexit issue. We've been quite vocal in the past about opposing Lloyd's withdrawal from the EU. We were sad to see that as the result of our referendum last year, but that is the result, and we have moved ahead with coming up with a contingency plan. And as you will have seen, no doubt, we have decided to press ahead with establishing a subsidiary office in Brussels, so within the EU, and that will enable us as a market to continue to write EU business through that operation, which we will be setting up and have ready to start writing business from the 1st of 1/1/19 renewals. So there are key priorities at the moment. I think in some ways they are all relevant to and related to the issue at question here today.
Thank you very much, Cameron. I will now turn to Dave Matcham, who will say a few words about more broader developments in the London market and his role in it.
Thank you, James. Good morning, ladies and gentlemen. I think you said more than a few, I had to say. So I've got about 15 minutes to take you through an analysis, really, of the London market's profile, demographics, position globally, some of our key challenges that we've identified through lots of interviews with clients around the world. And then I will also try and bring in how the work streams that the London market is working on relate more directly to the Islamic Takaful world or Sharia-compliant products, which, as I'm sure you know, the London market is very much open for business for. It's a key opportunity for London in the future, now and in the future. Just to say at the outset, as James said, I run the International Underwriting Association, which by definition is a very broad association. We have members, 50 members from 12 different countries, all of whom have chosen to have a base in London of varying sizes, some very big, some quite small. because of that, and because this panel does touch on Brexit, it's actually hugely important and affecting the membership of IUA, arguably more so than other sectors in the market, the brokers or Lloyd's, because we have 12 American companies, 10 Bermudan companies, 13 branches of EU companies in London, 5 UK registered companies, Japan, India, etc. And they all are having to think about their Brexit plans. So I'll touch on that during these comments as well. First of all, I'd like to draw your attention to either the online version of this document, which is called London Matters 2017. There are copies available outside on the IUA's stand. I don't think there's that many there. So if you would like a hard copy, please register your interest and we can send you one. But it's downloadable from the website of the London Market Group. It's important to just explain the London Market Group, first of all. That is not a company, it is a committee within the London Market. It's charged with overseeing, devising and implementing the strategic direction of the London Market. It's chaired by Nicola Aubert of Willis Towers Watson, who I think is the Deputy Chief Executive of that company. So it's chaired by a broker, but it has equal representation from Lloyd's, with Inga Beale as CEO and Shireen Corey-Hark as their COO, an active interest from the Lloyd's chairman as well. It has chief executives from 3 or 4 of the largest managing agencies, companies, and the top 3 brokers. So it's a very significant committee amongst the hundreds that exist in the London market, because we do like a committee in the London market. And it's really grown in stature over the last 4 years and extended its remit way beyond just technology or market modernisation. It now has what we call a growth and modernisation agenda. So under the auspices of that group, this document, London Matters, was prepared. It's now entitled The Competitive Position of the London Insurance Market. It's version 2. This is the 2017 version. Version 1 was 3 years ago. Still valid, still lots of good stuff in there. But this version 2 really took it to a next stage. Let's analyse how much progress has been made in those 3 years and see if the work streams are still relevant, change them if necessary. Within the document, we know it's a very, very tough market at the moment. Both Terry and all panellists have mentioned that. But the issue really is, how do we prove that? We need some facts behind that. We can't just rely on anecdotes. And so the first thing the document did is set out the fact base of the market, updating it from 2014. It also looked at trends. Had we grown or shrunken in various sectors and geographies over that period? And it also compared the market to other hubs like the London market. It also, and lastly, the second part of the document is these 125 interviews with key clients, risk managers, brokers around the world. Why do they use London? Why don't they use London? And the findings there really determined the work streams thereafter. So the good news was that London is still the largest global centre for commercial and specialty risk. It's now measured at $91 billion of premium. The previous number was quoted at £60 billion. It's now, we've changed it into a dollar conversion because that's much easier to recognise from an international perspective. And of that 91 billion, 67 billion of it is physically written in the London market, and 24 billion of it is either facilitated by London market brokers in London or controlled by London market companies in London. So the latter being branches, for example, of IUA member companies in Europe and Asia. I'm just going to refer to one page in the book just to give you some other interesting data, just to put it into perspective. So it also confirmed that London is 8 times bigger than Singapore, 2 or 3 times bigger than Switzerland, ditto Bermuda. All these competing centres for London where we know business is being retained and written in stronger percentages. We also looked at the demographic of the market. 52,000 people are employed by the London market, of which 35,000 are physically in London, but interestingly 17,000 are actually around the regions of the UK, Scotland as well. In economic terms, because this is very important to get our notice, the government to take notice of us, we contribute 26% of the city's GDP and 10% of London's overall GDP, and these are 2015 numbers. Lastly, just looking at the data and the trends, this is where we were able to confirm that we're still the largest global specialty market, but it's not all good news in terms of the types of business being written by London. So for marine, energy, aviation, the sort of traditional specialty business, London is certainly holding its own, if not small growth. Fairly static in property and casualty, but the key finding was that for reinsurance, London's market share is falling. And not only is it falling, and reinsurance is a very, very important part of the overall book, because often that's the only way you can write business from overseas. Not only was it falling, but it's falling dramatically compared to the growth percentages in the emerging economies. So for Asia, Latin America, Africa and Australasia, apart from Australasia, the other three are growing by 3%, 4% and 9% respectively. We're actually losing market share of up to 2%. So these were the findings. This proved the challenging situation that we were finding ourselves in. So what the second part of the report was the client feedback. And whilst again we were seen as trusted, we're a good regulatory regime, often providing products that were needed, a place to go to for hard-to-place business, those sorts of things. There were, again, 4 key sort of challenges that were identified here. And it's interesting here in the initial comments to this conference, some of these certainly are very comparable to the Islamic finance world. Number one, whilst we may be innovative, we're not necessarily as responsive as we could be in terms of development of products. So London's always known for its innovation, but in actual fact, the risk base of clients is changing quite dramatically, and there was a feeling that the insurance market is not keeping up with the development of products to satisfy the new risks. Secondly, and Cameron referred to this, London is just too expensive to deal with, and it's also highly inefficient. The good news on the efficiency point is that every market's inefficient. We weren't seen as the worst by any means, but we certainly weren't the best. And it's actually a clear opportunity here. If we were better, if not the best, that could well attract more business to London. Thirdly, and this again has been touched on already, there's a clear preference to grow local markets, i.e. not to export business into London. Reinsurance is the most obvious exported product, and even that is under more pressure now because a number of these emerging economies are looking to almost close up their market, at least partly, if not fully, to protect the local reinsurance market, thereby encouraging growth of their market, which is not necessarily always the right answer given the risk profiles and catastrophe exposures of many of these countries where local markets clearly couldn't cope. And lastly, the talent and diversity profile of the London market was not necessarily seen to fit with the modern world. We know, for example, that London's percentage of women on boards or other religions being represented in senior management roles is much lower than in other, even financial service industries like investment banking. Well, we're in the sort of below 10% range and they're in the 30s. So that was a key finding, really, that it's almost like we're talking to ourselves too much and not reaching out too far. So with that in mind, the work streams that have now been introduced have carried forward from 2014 to this day. There are 4 of them. The first one is we need to tell our story better. We need to promote ourselves better. We need to have a collective narrative that we all buy into. It's a highly competitive market with 125 insurance companies and 150 brokers all wanting to compete for business against each other or for new business that comes to London. That's fair enough. But broadly speaking, we're not telling the London market story as well as we can. The first thing that was done on that was a brochure translated into many languages was sent around the world into every embassy, consulate, etc., with the help of the UK Trade and Investment Department of the government. And certainly within that, mention is made to London's potential offering for Sharia-compliant products. That's one of the innovations and specialty nature of London that we can provide. Also, we're looking to introduce a brand, some form of London market brand, where it can support the market's growth, support its promotion, similar in a way to the brands that you might know if you follow English football. The Premiership football is a massive brand, but there are big brands within the Premiership, like the big football teams, Man United or Chelsea. That's the sort of idea that's trying to be fostered within the London market. We've got big brands like Lloyd's and Aon, AIG, whoever, but there must be some branding work that can be done above that. The second work stream is to have a much better and deeper relationship with government. This was very patchy beforehand. Ironically, 6 months before the EU referendum result, we actually had a much better structure in place to work with and talk to government. And then Brexit happened, and we were well placed, therefore, to begin that dialogue. In fact, I'm not sure exactly where other industries are on Brexit, but the London market and the financial services industry through City UK are both very well placed and very well connected to represent our interests in the Brexit discussions. The other tangible thing that's come out of the government relations work is the finalisation of regulation to enable insurance-linked securities to be effected in London with a tax and regulatory regime that's responsive and competitive to other centres around the world. That was a real massive result for London and hopefully will bring more business to London. Thirdly, we need to expand the talent and diversity work within London. Now, this can be done in many ways, and of course, many of the big companies and brokers have their own initiatives in this area. But I'll give you one example of where the London market is doing it. We now have something called London Insurance Life Ambassadors. And these are younger professionals within the market. There are currently 45 of them. And they're people working for insurance companies or brokers who go into the schools, go into the colleges, in the work time, supported by their employers, and are able to basically promote the London market at that level and other levels. There's also now the use of social media quite extensively. For example, the London Market Instagram page, which posts opportunities to work in London and has currently already attracted 2 people working in the London market. One's joined AXA and one's joined Liberty, and they only found out about this through Instagram and the fact London market use social media in that way. So we obviously need to embrace the way younger people think much more. And lastly, again, as Cameron referred to, the modernisation piece, making London a more efficient place to do business in. This is something called the Target Operating Model. It's been going for about 3 years. It has many facets. The idea is to standardise data flows using Accord standards, to eliminate rekeying, eliminate duplications of work, eliminate inefficiency and cost in the system effectively. And the key underpinning to all this is electronic trading. So again, London has not really embraced electronic trading to any extent. Many failed initiatives in the past, but we at last have one that seems to be working. It's called the Placing Platform Limited. That's the name of a company that's effectively rolling out a market utility to enable risk to be bound electronically within the market, without losing necessarily the face-to-face negotiation that is one of the sort of sweet spots of London, really. So far, there's been 6,000 risks bound onto that platform within 3 classes of business, which are terrorism, financial lines, and marine. And we're expecting a big jump soon when a brand new shiny release of the software is exposed to the market fully in hopefully September. There's no firm date for that, but it's in testing mode at the moment. So these are all they're the 4 key initiatives that the market is working on to address the challenges that were identified through the client feedback and the obvious challenges in the world. Where does this fit into the Islamic insurance Takaful world? Each of those work streams can relate to the growth of those products. So if you look at innovation, for example, there's no reason at all, innovation and telling our story better, there's no reason at all why the branding and the literature cannot include the fact that London is open for business for Sharia-compliant products. We absolutely should have close working relationships within the market with the Islamic Insurance Association of London, which was an association formed a couple of years ago. Max Taylor, who chairs it, will give a short speech this evening at your dinner. And this is really looking to promote standards, promote networking and understanding of what London can offer in this space. Secondly, on the working with government, there's many of the jurisdictions that are displaying protectionist tendencies on regulation are areas where there are clients who could clearly be supported in a Sharia-compliant manner. Malaysia would be a good example there. And so we're always keen to brief people who are attending government or the Lord Mayor who's attending those jurisdictions on those points. The government is very interested in promoting a Sharia-compliant product set within London, and that's all to the good. On the talent and diversity side, there's clearly a dearth of cultural understanding within underwriters and brokers, I would argue, who we need to understand this culture better to therefore understand the needs of the clients better and have more data, more placing brokers or underwriters involved in that business from that culture. We're way, as I said earlier, we are way below the curve here on diversity. And lastly, the modernisation point, it's equally available to any form of placement. There's no barrier there. We know the Lloyd's model fits very well with the Takaful principles, and the insurance companies and brokers are also equally able to satisfy that within regulatory boundaries. That covers quite a detailed explanation of the London market's current activity and thinking. I haven't really touched on Brexit. I'll just do 1 minute on Brexit if you'd like. So obviously we're all very familiar with the status of the country within the Brexit situation. Our 48 members are all exploring contingency plans, as have Lloyd's. So there's at least 50 or 60 insurance companies within the London market who are looking how they can continue to trade EU business after March 2019. We're really talking to the government about some of the things we'd like to see in the future arrangement. We are rather ambitiously asking for mutual market access, so for London insurers to have access to EU and EU insurers to have access to London. We've not diverted from that thus far. We may arguably be more optimistic given the result of the general election on that basis now, but it's very hard to predict. We are very keen for Solvency II equivalents to be retained. I think that's obviously much easier in the first weeks and months after Brexit takes place. But in years to come, we may divert from Solvency II. There is a lobby in some life insurance areas for changes to Solvency II, not so much on the non-life side. And there is also, clear rhetoric from government that we want to be a rule maker, not a rule taker. So we can't necessarily just follow the EU at every step. And two other points that we think are important on Brexit, at least in the short to medium term. One is the issue of transitional arrangements or implementation periods, whatever you call them, that period between the end of the negotiations or the end of the 2-year trigger period and when we are fully out of the EU with the deals in place. We need a period of stability for the certainty that clients need thereafter, which talks to the last point, which is this thing called grandfathering, where we have many, many hundreds of policies in the retail, life, non-life, wholesale space, where EU clients have bought products from the London market and they easily straddle that expiry period of the 2-year trigger. I'll give you one example. In Germany, there are 500,000 German pension products sold by one UK life insurer. All of that would have to be somehow dealt with in the negotiations, the transition, and the long-term position. So Brexit, unsurprisingly, taken up a huge amount of time, management time and expense, but has jumped on many companies' risk registers into the top 1 or 2, despite the market conditions that we've always spoken about.
Thank you very much. Thank you very much, Dave. So we've briefly covered, but in a lot of aspects to it, the impact of Brexit, developments in the London market, and we've touched on London market's efforts to support the Takaful industry globally. Conscious of time, but I would like to give everyone an opportunity to ask any questions of Terry, Cameron, or Dave, or myself. So are there any questions to kick off? Is there a lady here?
Just here.
Thank you very much.
Hello, I'm Iman. Hello? Yeah. I just wanted to touch on the point that you mentioned about the grandfather ring. What was the outcome for the pension? Because that's a big thing, you know. Where you straddle the 500,000, you know.
That's just one example that's
so
been quoted.
How was it resolved?
It hasn't been resolved yet because no one knows the position within either the free trade agreement that will be negotiated probably towards the end of this year, the beginnings thereof, or the position of transitional arrangements. So what companies are having to do is form a subsidiary within the single market somewhere. So Lloyd's have chosen Brussels. I think 3 companies have chosen Brussels that I'm aware of. 5 have chosen Luxembourg. 1 has chosen Munich. Some have chosen Dublin. Malta has been looked at. Some other cities have been looked at as well. And a lot of companies haven't even gone public yet on what their contingency plans might be. And they're having to form this company either to have a new company with a portfolio transfer, what they call Part 7 transfer, which can take some time, or a conversion into what they call an SE, which is like a European limited company, I think. So they're all working out the best ways to do it, and then in the event that there's either no deal or there's a deal that makes it difficult to continue after the end of the trigger period, those policyholders can be serviced through that subsidiary. That's a solution, but I don't know what the solution will be. I think it will be a longer term rollout of various solutions, probably.
Thank you very much. Next question.
Thank you very much. Mr. Cameron, you mentioned that the Lloyds, they will open office in Brussels. Would you please tell us what will be the function of this office in Brussels after Brexit? And what about the other insurance industry in London or insurance company? They will open an office in Brussels after Brexit or not? Thank you.
Thank you, Mr. Garamaya. I mean, the function, as Dave has described, really, the function of the Lloyd's European subsidiary office will be to, if you like, channel all the existing business that we currently write from London, which we will no longer be able to do. We will still be able to access that business, and more importantly, our customers around Europe and around the EU will be able to access Lloyd's specialist capacity and so on, but through that subsidiary office. The workings of how that will happen are still being designed as we speak. So I can't tell you the ins and outs specifically, but there will be a mechanism that will be an EU-regulated entity in Brussels, regulated by the Brussels supervisor, that will enable all the business that Lloyd's currently writes from London to be channeled through that subsidiary and still come back into the London market. I think your second question was, will other insurers in the UK and London be setting up subsidiaries? As David said, I mean, each company will have its own approach to mitigating what is happening with Brexit. Some have chosen Brussels, some have chosen Dublin and other centres, Luxembourg. Others are still working out what their plans will be, I guess. It depends on how important European business is. For us, it was very significant. It was about 15% of Lloyd's global portfolio of business. So it was very important that we had some contingency plan to enable us to continue to access that business and our European clients to continue to access Lloyd's.
Terry, could I ask you to say a few words?
I surrounded by two colleagues here, but I think, you know, whilst London, and I point to both of them, is working the technical answer as to how to deal with the regulation, when you're working with clients around the world, and the answer is, you know, we'll be placing insurances over the next 18 months or so, and especially construction risks and other areas. If the London answer is we don't know yet, but we haven't quite worked it out, you know, it makes it far more difficult to push London as a placement area compared with some of the local centres. So I don't know whether either of my two esteemed panellists have comment on that.
I mean, all I'd say is, I mean, it's a very good point, Terry, of course. I mean, which was why we were quite quick at Lloyd, certainly, to come out and say, we have a plan. And as soon as the Article 50 was triggered, that day or the very next day, we said, as Lloyd's, we have a solution. It's going to be Brussels. Yes, the ins and outs of and the fine details of the workings, many of them are in place. I'm not particularly au fait with them, so I'm not going to stand up here and pretend I know exactly how it's going to work. But there is a system that is in place that will enable the business to continue to flow, and we will be up and running as of 1/1/19.
It's every company is different here. So if I look at IUA members, some might say, don't need to do too much. I've got a fairly sizable European operation already. I am just happy for the business to stay within the group, not necessarily go to London. You know, that happens a lot. The other aspect that is hampering planning is having no real direction from the UK government regulator at the moment. So the PRA in the UK has issued a questionnaire to all companies asking for details of their contingency plans. Now, some of these companies are regulated by the PRA because they're either UK or American or Bermudan, etc. But many, I mean, I said we've got 13 branches of EU insurers within our membership, and that's big names like AXA, Allianz, Munich Re, etc., Generali. They are not regulated by the PRA at the moment. They're regulated by the FCII for conduct, but not on solvency purposes, because that's how the single market works. And so the PRA are actually in a difficult position to know how to plan for contingency planning. They don't know how many new applications for subsidiaries in the UK they're going to get. The general sense is that you have to be a subsidiary. That's the safest option to go for, because you can't rely on the fact that you can still trade as an EU branch post-Brexit. So you've got just all sorts of levels of uncertainty, unfortunately, that all need to be ironed out. We have, with the ABI, made some representations to the Treasury, UK Treasury, to see whether there's any ability for these EU branches to have some sort of temporary period of trading post-Brexit without being a subsidiary. There's a certain provision within the Financial Services and Markets Act that could be implemented. In some ways, it's a little bit like the EU nationals argument. If the UK gives a signal, it might actually help cure some of the uncertainty at the moment. But it then gets political, I'm afraid. So.
Thank you very much. Next question. Sorry. Afterwards. Sorry, the lady just over there. Thank you.
Hello, thank you. Can you hear me?
Yes?
I wonder if you can say anything about London Market and an office in Malaysia and what that might mean for Takaful.
Who would you like that directed to?
Any one of these experts.
The simple answer from me would be that would be down to individual companies to do. There's not a London Market entity that could be formed that could operate like Lloyd's. So Lloyd's would have an option to have an office in Malaysia, which I think they've considered or are considering. And then I'm sure there would be perhaps some of the bigger reinsurers especially looking to form a similar... if they feel that's something they want to pursue, then that would be the obvious way to satisfy it.
I'll follow up on that. It's a very good question, very relevant question. Obviously, Malaysia is an extremely important market for Takaful and re-Takaful. We have looked at establishing a conventional or acquiring a conventional reinsurance license in Malaysia. Those plans are on hold for the moment. What was clear, however, is were Lloyd's to do that, we would then need to go through a very separate process to get a Takaful license or re-Takaful license. They are very two distinct processes. It's something that will remain on our watch list, definitely. It's a very, very relevant market, of course.
I don't think we've touched yet on the demand for a re-Takaful business, and certainly I think we would say that Malaysia, with a regulatory position, should be a very good market to be able to develop from that point of view. I think the comments made about Brexit and how London is dealing with Brexit from a technical point of view probably means that we are capable of innovating and finding ways of dealing with the regulation as required, as kind of Cameron said. But I think that demand is vital for the work to be done. Sort of as an example, and it was actually in the document that David referred to. Whilst the Takaful and re-Takaful insurance business has grown very slowly, I would suggest, in London, cyber insurance premiums have grown over 70% in the last 2 years alone. So when demand is there, I think London has done very well at innovating, growing expertise, bringing in people from other disciplines, into the insurance world to deal with the risk transfer and a risk sharing option. So I think I'd like to say that we can do this when the demand is there.
Can I just add to that point?
Yes.
I think that's a very relevant one. In a sense, that the preamble to this session was about London's appetite to provide Takaful and Takaful products on the back of Brexit. In other words, we will be more incentivized because of the closing, if you like, of one market to be more open to providing Sharia compliant capacity to new markets or other markets. I think Brexit is just one other reason for London market insurers to do that. I think they're already thinking about this. I mean, these are challenging market conditions, but for those very reasons, to my mind, what I see is that insurers and reinsurers in the London market are thinking rather creatively about how they can access markets and be relevant to all communities worldwide, because it's difficult to make money in the conventional market. So I think I'm quite optimistic about London's position and readiness to step up and actually provide the sort of capacity that our customers globally require, whether that's in conventional markets or in, Sharia Islamic markets.
Thank you very much. Alberto. We'll do Alberto and then yourself.
Thank you, James. With regards to Solvency II, I heard two different positions. One says that Solvency II will be implemented, and the other one says, somebody else says that possibly will be after Brexit comes into implementation, will be possibly be phased out. What is the...
Thanks. No. Solvency II has been implemented. That's fine. It's now being complied with and the various reporting requirements, etc. In fact, in many ways, the UK industry was pivotal to the development of Solvency II, and so it very much supports many of the concepts. And that will be the case on day one after Brexit, whatever transitional or implementation period there is. So we would argue strongly there is no reason why we should not be seen as Solvency II equivalent as a new third country to the EU. If you take other Solvency II equivalencies, Bermuda and Switzerland are the two best examples. They changed their solvency regimes quite dramatically to become Solvency II equivalent, but it's not Solvency II as you would know it, as we would know it. And so so there's no change on day one, probably day 100 even. But there has been this statement made by the Bank of England that in this new world, we will not be a rule taker necessarily. We have to make our own rules. And we have heard, just tentatively thus far, there's been a couple of reviews of Solvency II already, that the life insurance industry especially are having some real problems with certain aspects of Solvency II. I think it's called the matching adjustment, something like that, and I'm not a life insurer at all. So there therefore is the potential down the line, and I don't know when that would be, when that lobby might get stronger and the government might think, yes, that is a fair point. We need to have a slightly better or different regime for that particular reason. That doesn't mean we still wouldn't be Solvency II equivalent. We'd just be slightly different to the way we were on day one.
Thank you very much. Gentleman.
Good morning. What would be the impact of Brexit on the cost of doing business for insurers and reinsurers in the London market and eventually on the insurance pricing? Because I have read in the news that this is causing inflation in other sectors.
Cameron? No. No, I mean...
I think time will tell.
Yeah.
I mean, there's going to be... certainly for Lloyd's, there is going to be an upfront cost of establishing a subsidiary in Brussels. That's without doubt. And, with that will be, a certain number of headcount, which we would otherwise not have been the case. So, but in terms of how that affects pricing, I think only time will tell.
I think that, there is a point that, and I think both David and Cameron made the point that the cost of doing business in London is considerable. And we know we're looking between us all at various ways of cutting down that cost in total. Just as an example, and again, trying to answer Iqbal's question of what else is going on outside of the Takaful world, and this isn't supposed to be any sort of Aon advert, but we have put together a number of facilities that you may have read about in the papers, and actually managed to increase our income into Lloyd's in 2016 by a significant proportion, such that instead of placing individual risks, we've actually been taking shares of those risks, creating a contract and placing it into Lloyd's and other London market companies. Part of the point of that is to reduce the cost to everybody of doing business. It's meant that the number of hands that touch it on the way through have reduced, especially in London from our aspect. There is a considerable debate, I think, going on as to whether that is also reducing the role of follow-line underwriters and how relevant they will be in future. But, you know, it's almost impossible to reduce costs without looking at the human cost on the way through.
Yeah, absolutely. I mean, it is a very hard question to answer accurately, but perhaps one thing that I've touched on already that could help this situation is the electronic trading that we're introducing. In some ways, Brexit is a great opportunity for it, because these new subsidiaries within the EU the brokers could easily talk to them much easier using the electronic trading environment, which should hopefully reduce the cost of business as well. But ultimately, forming a new subsidiary is going to be costly, and that will have to be factored into your overall financial position.
Thank you very much. I've got time for just one more question. Gentleman at the back.
I would just like to know that the London market's viewpoint about Takaful, whether they see it as simply an innovative product or an innovative system and rational system in the insurance market.
Shall I take that one? Yeah. So the London market produces a number of products around the world based on demand, and we touched on that. Where there is demand, then the London market will take the principles. Actually, the principles of Takaful, talking about Lloyd's, goes back to the coffee shop days, and they are something that is respected in terms of mutuality, in terms of our transparency, in terms of sharing in the rewards. Those are principles that the London market abides by. They are regulatory principles as well. And we also look at the aspects of risk management broadly, which not only encompasses an insurance policy, but also works with clients to prevent insurable losses. So I would do an answer and say that London market has a lot to learn from the Takaful world, and we would like to share on that journey. We haven't arrived there. We believe there's a lot of development to come. Lloyd's are making efforts. Some of Dave's members are making efforts, but we know this is a collaborative approach. We want to share in exchanging skills from both parts, from the Muslim world as well as the London world, for the betterment of both. Eventually, and as you know, Sharia compliant products are open to not just people who deem Sharia to be important, but anyone else. It's just a good product in the view of the London market.
And I have a little bit of an ask on this of people in the audience. Really, is that you know, as James said, we think we've learned a lot about the Sharia products, but in talking to some clients, you know, they still have questions on the London offering, and so if people feel that, you know, we could improve the products that we're trying to offer, you know, please tell us, and not just, you know, head to another market.
Agreed. Well, thank you very much. Our time's up. And first of all, I'd like to thank our panellists, Cameron Murray, Terry Masters and Dave Matcham, and perhaps a round of applause. Thank you.